All right, Brian Belski has talked about Canadian markets. Let's talk about U.S. markets with the chief investment strategist at BMO Capital Markets. We'll keep it going here, Brian. So S&P 500 up more than 20% 2 years in a row. It's only happened a couple of times. And you say, again, meeting with clients, that you're getting some pushback that this rally can sustain itself. Why is that?
Yeah, I think because, again, most people can miss the move, and they've been kind of exceedingly questionable with respect to tech's overall strength in 2025. That's kind of number one. Number two, I think you can have a belief that the stock market can be in a cyclical bull market. Like this is year 3 of the cyclical bull that started in October of 2022. However, I think I can count on maybe 1 or 2 fingers on how many clients actually believe our overall call that U.S. stocks are in a 20 to 25-year secular bull market. So I think people want to think they can time the market. There's been different things with respect to factors working in the United States market. So many people are focused on momentum factors and technical factors. Everyone's a technician now, where people have forgotten, if you go back to 1990, which we have back-tested factors in the United States, 4 out of the 5 best factors in the U.S. are fundamental. So price to free cash flow, enterprise value, EBITDA, earnings growth, and capital usage. So at the end of the day, I think we're going back to those types of things. And I think when you start talking about stock picking, where the performance within sectors is very varied, that means you have to focus more on stocks versus the sector. I think a lot of institutional investors, quite frankly, are not positioned for that because they haven't been classically trained for that, because they've been basically trying to make market calls and chase ETFs and call the market. So that makes us more bullish because we're portfolio managers and we run 10 equity portfolios for BMO, 8 SMAs. And of those 8 SMAs, our average outperformance is 650, almost 700 basis points relative to the overall market. So we like to buy stocks for the long run. We buy more when they go down if we really like them. We only sell stocks if there's something fundamentally broken with them.
On the technology side, it's been leading the way for years now, really, as you point out in your notes. And you're still overweight tech. Is that sort of a do people complain about that as well? Tech can't. Yeah.
Belski, and I'm the perpetual bull and stubborn. Well, we've said for now 15 years, even before we came to BMO, that the big technology stocks are the new consumer staple stocks. So Apple, Microsoft are technically technology companies, but Netflix and Google are communication services companies. Those 4 companies are consumer staple companies. We use them all the time. They're on our person all the time. And they're like the old soup companies, food companies, Procter & Gamble's, Kimberly-Clark's. We're not using those companies in our regular day life. We're using these big tech companies. That's kind of number one. So you have to maintain positions there as your core position. And then you trade around the apple, right? So the core of the apple are these consumer staple names. And then the rest of them are the lower cap companies, Oracle, AMD, Qualcomm, Broadcom. We think Palantir, those are going to be the names that really drive the performance and the alpha in the technology sector for the next 5 to 10 years.
All right, and then consumer discretionary, you think that earnings revisions have come down to the point where it's a nice contrarian play there?
They are. So if you strip, the best way to play consumer discretionary is to have a barbell. On one side of the barbell, you have Tesla and Amazon, the big behemoths in the sector. But I think we're going to get alpha with respect to stock performance and risk-adjusted returns and Sharpe ratio type of work is going to be the smaller names like Lulu, Marriott, TJ Maxx, Home Depot, Starbucks even, because that's where from an operational perspective, earnings have bottomed. We saw the result of earnings bottoming in a stock called Lulu here in Canada, listed in the United States. They crashed their earnings first half of the year. Earnings were too low then. Now they're starting to come back and the revisions are going up. That's exactly what's happening in a lot of these names, Mark, that most investors are missing in the consumer discretionary sector. So never discount the U.S. consumer, ever. And the U.S. consumer is very smart at what they do and how they buy things. And so we think that type of trend with respect to revisions bottoming, from our backtesting work, that's exactly when you want to buy consumer discretionary.
Okay, you and your team have a S&P 500 target of 6,700. That'd be about 10% gain from here. So how does it get there?
We think it gets there by having earnings growth, especially the second half of the year from financials. We think some of the deregulation part of it. And we do also think, too, the steepening of the yield curve and lower interest rates are going to help spur loan growth on the financial side. But we really, really, really like the big banks and the really small banks because that's where the big growth is going to come from.
And Back to President-elect Trump. His influence, depending on what the policies actually are that are enacted, which sectors will be most impacted positively, which negatively, do you think?
Well, I think a lot of people want to jump on energy because of the drill baby drill comment. We're not gonna buy energy because of drill baby drill. We're going to buy energy because we're starting to see global growth increase and the overall commodity price is going to increase. We think commodity prices actually in energy could go lower. And so we're more neutral there. That's one thing to start thinking about. I do believe that regulation on the negative side in terms of a headwind is coming for healthcare. And you have to be really, really careful on that. Also consumer staples and some of these packaged food, because in America we have this issue with overweight syndrome, and a lot of these packaged processed foods have really hurt people. And so I think there's going to be a lot of things being thrown at those types of names. And I think that's going to be a real issue with respect to some of the regulations coming into those sectors.
So lastly, stick with good companies. The Trump talk is probably overblown. And just lastly here quickly, do you think Trump only has so much tolerance for the market rolling over and the economy rolling over? And if he finds that some of his policies are hurting things, then will he reverse course quickly?
That's an excellent point. I don't know if he's going to reverse course, but I don't think he's going to get to the point where he's putting all this pressure on the market like most people think. He loves the stock market.